Assalamualaikum to everyone. So our group will present about Mpers. So for the first slide, Mpers for SMEs will be explained by me, Nurfazurin. And then for Undue cost and effort will be explained by Atira. Then I will continue with challenge of Mpers. Next, implementation in employee benefits will be explained by Arnie and Raida, while implementation in share-based payment will be explained by Madiha and Nabila. Mpers. So Mpers, also known as Malaysian Private Entities Reporting Standard, which was issued in February 2014. The framework effective for financial statement beginning on or after 1st January with early application permitted. Mpers is based on the International Financial Reporting Standard for small and medium-sized entities, issued in July 2009, which later replaced as the Private Entity Reporting Standard. It's the simplified version of MFRS framework. It has 35 sections covering all the relevant areas for financial reporting by private entities. In October 2015, 63 amendments were issued in line with the amendments to IFRS for SMEs. The amendments are effective for annual periods beginning on or after 1st January 2017, with early application is permitted. Prior to 2006, Mpers was developed based on accounting standard issued by IASB and also contains local accounting standard developed by the MASB. Dynamic developments in the international accounting standard and business environment demand for an up-to-date accounting standard that is compatible with international norms for private entities in Malaysia. With the adoption of Mpers, it contributes to enhance the comparability, quality and transparency of Malaysian private entities' financial report globally, encouraging cross-border activities and opening up new opportunities. Is Mpers the only option for private entities? Private entities that were applying the financial reporting standard framework instead of Mpers in their financial reporting have been given the option to transition to either MFRS or Mpers for annual periods beginning on or after 1st January 2017, with early application was permitted.
The definition of undue cost and effort. It is excessive cost or effort incurred in the process of preparing accounts. It is cost overweight benefit. In 2014, original Mpers, numerous exemptions on measurement were given on the ground of undue cost of effort. The concept of undue cost or effort was not explained. In 2015, the amended Mpers clarified that, considering whether obtaining or determining the information necessary to comply with a requirement would involve undue cost of effort, depends on the entity's specific circumstances and on management judgment of the cost and benefit from applying that requirement. For example, hiring expensive chartered valuer in perform valuation on investment property for fair value disclosure purpose. On certain circumstances, it is not required since it is too costly the small company. The judgment requires consideration of how the economic decision of those who are expected to use the financial statement could be affected by not having that information. When applying the requirement early application, it would involve the undue cost of effort by a private entity. For example, the incremental cost, valuers' fees, or additional effort, such as endeavour by employees, substantially exceed the benefit. that those who are expected to use the private entity financial statement would receive from having the information, since its qualitative assessment typically not possible to quantify the benefit that user will receive. Through this assessment, private companies such as SMEs would usually constitute a lower hurdle than the undue cost or effort by a publicly accountable entity. Management could make an assessment of undue cost or effort. This is to highlight what is meant by the undue cost or effort exemption and when it can be used. This exemption should be made initially in recognizing an item and in any subsequent period, based on the information that is available at that time. On the initial recognition in the financial statement, at the date of transaction should be based on information about the cost and benefit of the requirement at the time of the initial recognition. In subsequent recognition, undue cost or effort is exempted. A new assessment of undue cost or effort should be made at that subsequent date based on information available at that date. When exemption is used by an entity, the entity shall disclose that fact and the reason why applying the requirement would involve undue cost or effort should be made in the financial statement.
Challenge of Mpers. First is constant change. Entities believe by implemented Mpers, there will be more rules and regulation changes in future. This will be a challenge for the preparer as they need to learn to be agile and flexible in order to keep up the changes in Mpers. Secondly is the talent shortage. This happens usually in small private entities as they cannot afford for better quality accounting service. Next, the additional cost. In order to implement Mpers, it will incur additional costs which can increase cost of the entities. For example of additional costs are staff training costs, increase of audit fees, and additional valuation fees to revalue some asset and liabilities. Other than that is limitation of application guidance. Mpers doesn't come with detailed application guidance in some complex areas. Sometimes large private entities may need to refer to guidance in Mfrs for their accounting requirement. Next is the comparability of financial statements would be difficult to achieve. It's because Mpers allow preparer to not apply a particular requirement if it involves undue cost or effort. Undue cost or effort is very subjective and difficult to operationalize. Therefore, it will make financial statements among the companies are not comparable. Lastly, certain areas are more difficult and costly as compared to Mfrs. For example, in Mpers, biological asset and investment property is measured at fair value. However, under Mfrs, entity is permitted to measure biological asset and investment property using cost model.
We proceed to Mpers Section 28, Employee Benefit. For the definition, employee benefits are all forms of consideration given by an entity in exchange for service rendered by employee, including directors and management. There are four types of employee benefit. First is short-term employee benefit. Second, post-employment benefit. Third, other long-term employee benefit. And last is termination benefit. For general recognition principle, an entity shall recognize the cost of all employee benefits to which its employee have become entitled as a result of service rendered to the entity during the reporting period as liability and expenses or asset. debit expenses, credit liability, or debit asset, credit cash. We proceed to measurement. Measurement for short-term employee benefit. When an employee has rendered service to an entity during the reporting period, the entity shall measure the amounts recognized at the undiscounted amount of short-term employee benefits expected to be paid in exchange for that service. Measurement for post-employment benefits. Defined contribution plan or defined benefit plan. We can follow the Mfrs 119. Next, entity measure at reporting date a defined benefit plan at the present value of its obligation minus the fair value of plan asset.
Next, we go to the measurement for other long-term employee benefits. An entity shall recognize a liability for other long-term employee benefits measured at the net total of the following amounts, which is the present value of the benefit obligation at the reporting date minus the fair value at the reporting date of plan assets, if any, out of which the obligations are to be settled directly. Next is the measurement for termination benefit. An entity shall measure termination benefit at the best estimate of the expenditure that would be required to settle the obligation at the reporting date. In the case of an offer made to encourage voluntary redundancy, the measurement of termination benefits shall be based on the number of employees expected to accept the offer. This is the comparison of the Mpers, Section 28 and Mfrs 119 under employee benefits. From this table, we can see the requirement for short-term employee benefits and for defined contribution plans, both in the Mpers and Mfrs 119 are same. Next, for the defined benefit plans under Mpers, an entity recognizes a defined benefit liability for the obligation under the plan net of plan assets, and the net change in that liability during the period as the cost of its defined benefit plan. While for the FRS 119, for the past service cost, is recognized as cost of current period, and there is no option of deferral. Requires independent actuarial valuation. Next is for the requirement on measurement. In the Mpers, under Mpers and Mfrs 119, for requirement on measurement, both are same, except that Mpers does not mandate an independent actuarial valuation, and there are some simplification in the measurement of obligation. And lastly, for recognition of actuarial gains and loss, for Mpers, an accounting policy choice is given to recognize all such gains and loss in either profit or loss or other comprehensive income. While for FRS 119, the remeasurement gains or loss, including actuarial gains and loss, must be recognized in other comprehensive income only, without any option of recycling to profit or loss.
Next, we will moving on to section 26, share-based payment. The definition of share-based payment is a transaction in which the entity receives goods or services, including employee services, either as consideration for its equity instruments or by incurring liabilities for amounts based on the price of the equity share or other equity instruments of the entity. The accounting requirements for the share-based payment depends on how the transaction will be settled, that is by the issuance of an equity, cash, or by equity or cash. Types of share-based payment. The first one is cash-settled share-based payment. A share-based payment transaction in which the entity acquires goods or services by incurring a liability to transfer cash or other assets to the supplier of those goods or services for amounts that are based on the price or value of equity instruments, including share or share options, of the entity or another group entity. For example, a supplier gets paid for its goods or services by cash, but the amount of cash is determined with reference to the entity's equity instrument price. Second, equity-settled share-based payment. A share-based payment transaction in which the entity receives goods or services as consideration for its own equity instruments, including shares or share options. The common way to remunerate some employees of big companies is by giving them share options in return for their work for the company. Next, receives goods or services but has no obligation to settle the transaction with the supplier. This is where the subsidiary receives goods or services from the supplier, but has no obligations to settle the transaction because its parent or another group entity is instead obliged to do so. There could be also some vesting conditions, and these are some services or performance conditions that the other party must fulfill before being entitled to share-based payment. For example, directors might be entitled to receive the shares of the company after 5 years of their service. These 5 years are a vesting conditions.
Next is recognition and measurement for share-based payment. First, for cash-settled share-based payment, it is to be recognized as goods or services received and corresponding increase of liability, and the amount to be recognized is measured at fair value of liability and to be remeasured at each reporting date and date of settlement. Any changes in fair value are to be recognized as expenses in profit or loss. So the measurement is debit expenses, credit liability, which is account payable. Next, for equity settled share-based payment, it is recognized as goods or services received and a corresponding increase in equity. And for the measurement, there are two types of measurement, which is for employee and for non-employee. As for employee, the service or goods received are measured at fair value of equity instrument on grant date, while for the non-employee, we need to measure at the fair value of goods and services received. But if the fair value cannot be estimated reliably or unavailable at that time, we need to measure indirectly using the fair value of equity instrument. So the recording will be the debit expenses, credit equity, which is reserve. Next, for share-based payment, Mpers Section 26 and MFRS 2, basically both Mpers and MFRS deal with the equity settled share-based payment, cash settled share-based payment, and combination of the equity settled and cash settled. And also, since Mpers are derived from the FRS itself, so the requirement, the recognition criteria, the measurement are all the same, which is as for Empress for private entities. So private entities also, if using Empress, must recognize expenses and corresponding equity and also liability when the employee service are received. But there are a few differences between Mpers and MFRS between the Mpers amendment, which is on the share-based transaction, which previously only applied on transaction that accordance with program established under the law. But after the amendment of 2015, all share-based transaction that identifiable and less than fair value of equity instrument granted or liability incurred can apply the Mpers Section 26. Also, there are a few amendments on other issues such as accounting treatment on vesting condition and modification to grant of equity instrument and simplification for grants plan.
Liabilities and equity. For scope, this section establishes principles for classifying financial instruments as either liabilities or equity and addresses accounting for equity instruments issued. Definition. For liability, a liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. For equity, equity is the residual interest in the assets of an entity after deducting all its liabilities.
Next is classification of financial liability and equity. An entity shall classify a financial instrument as a financial liability or as equity in accordance with the substance of the contractual arrangement, not merely its legal form, and in accordance with the definitions of a financial liability and an equity instrument. This is an example for financial liabilities and equity, which is issue of shares or other equity instruments, sale of options, rights and warrants, bonus issues of shares and share splits, convertible debt or similar compound financial instruments, or treasury shares.
Now, I will explain regarding Section 24 Government Grant. This Section 24 of Mpers specify the accounting for all government grant. The definition of Section 24 Government Grant. It is assistance by government in the form of transfer of resources to an entity in return for past or future compliance with certain conditions relating to the operating activities of the entity. An entity shall recognize government grant as income when the grant becomes receivable from government. It can also recognize government grant as income when the specific conditions are met. An entity shall recognize government grant too as a liability for the grant received before the revenue recognition criteria are satisfied.
Next is the journal entries for the government grant. So debit receivable or debit cash, then credit deferred income. For the measurement, an entity shall measure grants at the fair value of the asset received or receivable.
Mpers Section 20 Leases. This section applies to agreements that transfer the right to use assets, even though substantial services by the lessor may be called for in connection with the operation or maintenance of such assets. This section does not apply to agreements that are contracts for services that do not transfer the right to use assets from one contracting party to the other. Classification and definition. Classification and definition. Finance lease. A lease is classified as a finance lease if it transfers substantially all the risks and rewards incidental to ownership. Whether a lease is a finance lease or an operating lease depends on the substance of the transaction instead of the form of the contract. 5 conditions of finance lease. 1. The lease transfers ownership of the asset to the lessee by the end of the lease term. 2. The lessee has the option to purchase the asset at a price that is expected to be sufficiently lower than the fair value at the date the option becomes exercisable for it to be reasonably certain at the inception of the lease that the option will be exercised. 3. The lease term is for the major part of the economic life of the asset, even if title is not transferred. 4. At the inception of the lease, the present value of the minimum lease payments amount to at least substantially all of the fair value of the lease assets. And 5. The lease assets are of such a specialized nature that only the lessee can use them without major modification. Classification and definition. Operating lease. If the conditions for finance lease are not met, it is classified as operating lease. A lease is classified as an operating lease if it does not transfer substantially all the risks and rewards incidental to ownership.
Next is recognition and measurement for Mpers Section 20 leases. For recognition and measurement, we divide into two, which is recognition by lessee and recognition by lessor. So first, for lessee, for finance lease, initially upon the lease contract, we need to recognize the right of use of lease asset and its obligation as asset and liability in SOFP. And the amount to be recognized is at lower of fair value of lease property or the present value of minimum lease payment. So the recording will be debit right of use of lease asset and credit lease liability. Then upon the lease payment, lessee should apportion minimum lease payment between the finance charge and reduction of outstanding liability using effective interest method. So the recording would be debit lease liability, credit finance cost and credit bank. And the lessee also need to depreciate the lease asset. So we debit depreciation on right of use of asset and credit accumulated depreciation. Next, for operating lease, the lessee should recognize lease payment as expenses over lease term on straight line basis. So, and the recording will be debit rental expenses, credit bank. It's same as normal rental for operating lease. Next is recognition and measurement for lessor. So, under the finance lease, initially, after the lease contract, lessor shall recognize asset held under a finance lease in its statement of financial position SOFP and present them as a receivable at an amount equal to the net investment in the lease. So, the recording will be debit lease receivable, credit asset. And subsequently, when the lessee pay for the lease payment, so lessor should recognize finance income based on the pattern reflecting a constant period rate of return on the lessor net investment in the finance lease. So the lessor should recognize debit bank, credit the lease receivable, and also credit lease income. Okay, for operating lease, the lessor shall recognize the lease asset subject to operating lease in SOFP and subsequently shall recognize the lease income from operating lease in SOPL on a straight line basis over lease term, which is debit bank credit lease income.